Good morning. Welcome back to Wise Insights. So we're going to start with a preview of today's Nonfarm payrolls, the FOMC projections, then the SPY seasonality and its performance up to date, before moving on to the technical analysis. Today, the Nonfarm payrolls is expected to rise by 75,000 new jobs added in August. The problem with Nonfarm payrolls right now is that after the last set of payrolls, which saw a huge revision of the previous month's data, Trump fired the head of the Bureau of Statistics, and now the integrity of the government agency is now in question. So the big question is, if we print something really strong, for example, 100K, 150K, could that number be trusted? And vice versa. If it goes really low, does that mean actually the job market is much worse because first because of the lagging effects and also the speed of travel? Because once unemployment starts spiking or non-farm payrolls start rising, they tend to slide quite quickly. The market has already priced in a pretty aggressive 5 cuts in the next 12 months, compared to a base case of 3 cuts at the beginning of the year. So the Fed has held on for a very long time onto its pause, and the market is now thinking that the Fed could be behind the curve here, and a more aggressive cutting approach is warranted. So the September cut is pretty much a done deal. The November, December, quite likely as well, consecutively. And then we're thinking about 50% chance or 40% chance for each of the meetings in the coming year. So that's kind of what the market is looking at right now. If unemployment rate rises above the 4.3% that has been estimated by the consensus, we could see November, December quickly become done deals too, and then an additional cut pricing for 2026. So now looking at the equity index, SP 500, this is a heat map of the monthly returns of SPY, which is the S&P 500 ETF of the past 10 years. So what we see is that September tends to be a pretty weak month. So if we have large jobs, it tends to happen in September. 2022, September was the worst performing month among others. And we had a consecutive run of 4 negative years between 2020 and 2023. For September, last year, we had a very strong bull market. So September was a bit better, but still underperformed August. And this year, we had a little bit of a wobble at the beginning of the month, but now it seems that SPY is back to its highs. Just looking at the year-to-date performance of SPY versus the previous 10 years, the SPY 2025 is this orange line here, up 11%. Year-to-date is a pretty good run because on average, of the past 20, 30 years, SPY delivers about 10% returns. So it's above average. I would say that the last 10 years have seen more elevated returns because of QE and large fiscal spending. But still, SPY, having had a pretty disastrous Q1, actually now back onto the median returns path of the past 10 years. That's pretty remarkable. So it's a very strong bull market. I think any weakness at this point is a buy the dip opportunity. It's not going to be straight back to the bear market. And I think in the past 10 years, the only year that has done pretty well up to mid-year and then fell off the bandwagon was 2018. That's the first trade war by Trump. And the Fed was hiking back then as well. But today, the picture is slightly mixed. The Fed is potentially starting a new cutting cycle again, quite early on into the all-time high, and that could support any weaknesses we see in the short term. So a slightly different macro regime. And of course, if the Fed ignores the market, ignores the White House, and insists on pausing for the rest of the year, it's a different picture. We could get another much bigger pullback again, but that's not my base case expectation right now. Also looking at where we are in the bull cycle. So the top chart measures the distance, the run-up from the 52-week low. So this measures the size of the bull run from the latest low. And the bottom chart measures how many days the market has spent, or SPY has spent, at its all-time high. And if you look at where we are compared to the past 5 years, we see that SPY actually spent over 30% of its days within the 1 year range at all-time highs before a very large bear market correction in 2022. And again, if you look at the beginning of the year drawdown, we see that the SPY has spent over 25%, almost nearly 30% of its days at all-time highs in the past 1 year before we saw a big correction. And currently, we have had a decent run-up from the 52-week low, but in terms of the longevity of this bull market, we're still in the very early days. We're spending not even 20% of the days at the all-time high. So I think the market is still quite skeptical of the sustainability of this rally. But what the equity market does its best is continue to climb the wall of worry over time. And it's unlikely we're hitting a generational top when a lot of people are still calling for bearish moves, still citing macroeconomic weaknesses, still thinking that we will get a massive crash. The top comes when the most bearish people have turned neutral or bullish, and there's no one else who is left to buy in the market. And then looking at last night's close, what we're seeing is that actually yesterday was one of the strongest sessions in the past 20 days. So the orange line is yesterday's intraday data, so starting from 9:30, ignoring the pre-market. And we're looking at comparing it versus the past 20 sessions in blue. And what we can see is that we are actually among the top 2 or even maybe 3 sessions in the past 20 days. Is a very strong session, and that's a suggestion that the bulls are still in charge. Something very notable we saw this week is that Google or Alphabet was cleared of the regulatory concerns about having to sell Google Chrome. So they're able to keep Google Chrome, but they have to share data with competitors to reduce the monopoly concerns. So that was good news for Google and Apple, who can continue using Google for search and receive large sums of payments from Google each year. So Google stock was up over 9% on Wednesday. So I have put data from 2018 onwards to see how Google has done in the next 5 days, 10 days, 1 month, and 3 months after a large spike on a one-day basis. And I've set the threshold a little bit wider, so from 6% above. So if Google rose by more than 6% in the past 6 years, it would have appeared on here. Out of all these occasions, every time Google rose by more than 9%, which is what happened on Wednesday, it saw negative returns in the next 5 days, 100% of the time. It's not a huge sample, of course. It doesn't happen very often. It happened 2019, 2020, and then 2024, April, and then the April of this year. So we saw forward negative returns on all those occasions. But if we widen the search a little bit down to plus 6%, plus 7%, plus 8%, the picture is slightly more mixed. We do get some positive returns in the next 5 days back in the COVID era. So the market continued higher after the strong bounce. If you remember this time when we started doing large QE on the back of the COVID shutdown. And then 2022 there are more like bear market rallies. We had a very severe bear market back then, so they continued through. 2023 onwards, so the picture is not very benign. So when we have big one-day rally, the forward returns look pretty negative on 5-day as well as a 10-day basis, and actually even 1 month as well. So only last year we saw a slightly positive 1 month return onwards, and even that was negated by the 3-month return. So looking at this historical chart, I lean towards fading this rally for Google. It does not mean I'm bearish on the Google fundamentals. I think it's a very strong business, especially given that it's actually accelerating in revenue. It's still valued pretty cheaply compared to its peers. So on fundamentals, nothing wrong with the business at this moment. But if we're looking at purely statistical, quantitative analysis, this is in the short term, Google could mean revert and give up some gains. Again, we're looking at the RSI over 70. So Google triggered the overbought region in the RSI back in August. So this counts when Google moves above 70 for the first time. So if it drops below 70 and it comes back in again, that also counts. But if you are just looking at the historical occasions when Google moves into the 70 overbought area on the RSI, the forward returns tend to be pretty red up until the 3-month period. So that also tells me that potentially we should be cautious now in terms of the price technicals for Alphabet. We will look at the chart analysis in a second, but this is the top analysis that I've recently added to the service that could be useful for us subscribers. Now, looking at SPY, this is before the non-farm payrolls, so just bear that in mind. But because we're looking at the larger trend, it doesn't really matter whether we get a little sell-off or a spike after payrolls. It's the structure that we're looking at. We've had a wave 1 and wave 2 of the April spike. And since then, the market has essentially been on a one-way. This dip below the trend line was a false breakdown that didn't quite touch the 50-day moving average, which is in blue. And now it's moved back above the trend line. It's likely we haven't quite started wave 4 yet. And this is why it's really difficult to fade the rally in a bull market. And it's actually better to just ride the trend. Now, non-farm payrolls could send the market higher if the labor market remains resilient, because that's strong for the economy, even if the Fed doesn't cut as aggressively. There's always the narrative that if the labor market is weak, the Fed is willing to cut more. That could be more stimulus for the market. So a lot of this reading the data the narrative is actually very backfitted. you can only interpret the news as good news or bad news upon seeing how the market reacts afterwards. Right now, the market is very bullishly positioned, coming into a new all-time high. So it's very difficult for bears to short and try to fade. And if you look at options market, there has been a lot of hedging going on, a lot of push buying in mid and late August. But still, the spot prices are moving higher. If we get a sell-off upon non-farm payrolls data, I think the market would want to buy back quite aggressively next week. Of course, there is the seasonality concern, etc. But comparing the market bias versus the seasonal tendency, I think it takes a lot to track this market right now. Looking at QQQ, so QQQ has not come back above this previous trend line, which may look like resistance right now. And that did make me think we could be starting wave 4. Because the price is still holding quite well above the 50-day moving average and actually millimeters away from the all-time high, it might still be too early to confirm that wave 4 has indeed started. Carrying on from what I said about SPY, I think the overall stance is bullishly biased. And I think the bar is pretty high for us now to confirm when the bigger pullback starts. So I would watch the market, how the market reacts in the next week before rushing into any conclusions. Looking at the 30-year yield, I did think that we had a good chance to break above this thin line resistance during the week. But the week job opening data priced in further cuts in the front end and pushed down the 30-year yield pretty aggressively. So we're back to the lower side of this triangle. And right now, it's actually really hard to say which way it's going to go. So we just have to watch and see how it breaks out after non-farm. And for bonds, same story. TLT is the same story. It managed to save itself and climb back up above the 200-day moving average, above this heavy volume profile. And now we're on the upper side of this triangle. Again, we just need to see how the market wants to play the breakout either side. US oil, where a mini rally at the end of last month going into September, and now we're back to the 200-day moving average. Not a lot to see here, really. And I think now it looks increasingly difficult for oil to make a new high here from here. And my read has switched to a more bearish one, which lines up with the fundamentals expectation of very high supply this year from both OPEC Plus and non-OPEC countries like US and Canada, versus weakening demand globally, especially in China. So the near-term path looks likely towards the mid-60s right now for this downward wave 3. But in honesty, if you just look back the past 3 years, we're in a very wide range, and the best play is essentially mean reversion, selling above 80 or 85 and buying it back around 60s has worked quite well for investors. So it might not be that useful to try to apply any of the wave theory or other technical analysis to this chart. Bitcoin has been quite difficult. So actually, for seasonality wise, August is a pretty bad month for Bitcoin. So Bitcoin tends to drop quite sharply in August, actually around the Jackson Hole. And that's also the same for gold. So we saw pretty weak price action in the second half of August. While Bitcoin fell, Ether stayed pretty strong, and Solana has picked up as well. So there seems to be a bit of rotation from Bitcoin into Ether, which is actually a typical move you would see in a crypto bull cycle. You see Bitcoin leading the way, and then capital rotates, taking profit out of Bitcoin and into Ether, those credible larger alts, and then before moving into more meme-like coins downstream. So what we're seeing here is not that surprising in the greater context of the bull market. Typically, Bitcoin is very strong in October, starting from end of September, going into October and November. So there is a chance that investors will want to position themselves ahead of this seasonal move in advance. So we could see the bounce here. And Bitcoin shares a quite high correlation, so about 0.6 plus 0.6 with SPY and QQQ in the near term. So the stock market strength could actually correlate with a bounce with Bitcoin here. Looking at the chart, it is a little bit difficult to decipher this exact structure. I have got possibly the wave 1, 2, 3, 4 here, and then this wave 5. Sorry. I initially thought we haven't finished this, but because the sell-off really severely breached our levels compared to the beginning of August low, so I am turning a bit more cautious in this region now, especially below the 50-day. But looking at this structure, it doesn't quite fit into my end of the year season expectation. And also, Bitcoin tends to move with gold with a 2-month lag, and gold has just broken out. I do think there should be one more high still in this bull market. But the price action hasn't quite given me that confidence just yet, confirmation just yet. So what I'm speculating here, and I use the word speculation to suggest that this is an alternative path, a more bullish path, but we need more bullish price action to confirm it. And that speculation is that we could have had actually a 1-2 setup here that would give us a very strong wave 3 impulse for October, November, going to the new year, that could land somewhere around 176K to even 200K before a larger degree wave 4 pullback. So this alternative structure would conform better with our broader bull market expectations, but we need positive price action in the near term to confirm this. And we have seen our machine learning model turning from risk off to risk on today. Looking at Ether has stronger relative strength than Bitcoin. I do think we are in the middle of a wave 3 here, and that could end in the 5,600 to 6,600 or even high 7,000 region. So when we hit this upper bound of this channel, we saw some resistance, and now, and for the past month, Ether has been trending more sideways towards the middle of this channel, but I do think we haven't seen the top yet. We should see higher highs in this structure. And our machine learning model has actually been very bullish on Ether, with pretty good streak going to show that the trend is pretty dominant right now for the bull side. Solana, again, we are seeing new highs here versus the July high. And just very simple rule of thumb, a higher high and higher low in the upward trend is bullish. Try not to fade it. I do think we're in the broader wave 3, slightly behind Ether on the relative structure in terms of the move, but we should be looking at 300 for this wave 3 of the large degree 3. And that is about 50% higher from this point. That would not surprise me at all, given how fast and how far Ether had moved in advance. So if this rotation thesis is intact, we should see strength from Solana in the coming month as well. Looking at Coinbase, unfortunately, Coinbase has been risk off in terms of our model, and it has stayed risk off for almost 2 weeks now. So the near-term picture is a little bit mixed. I still lean towards this being a wave 4 here, and we could have the 200-day moving average in red as support, which coincides with the 0.618 retrace of this wave 3. In truth, this retrace is pretty steep, and going below this level here probably marks this as the top rather than a partial pullback for the larger degree wave 5. I think coin needs to prove itself. If it can stay above this frame, getting back to 323 and above the 50-day moving average, we may have started wave 5. But right now, we just have to be a little bit more patient for Coinbase to show its hands. Food, very similarly, I do think food is in a wave 4 correction. Not as deep as Coinbase. It's not even touched the 0.236 retrace of this wave 3. But there is room for it to pull back further towards 82 at the 0.382 retrace of this entire wave 3. But just looking at the whole structure, I'm skeptical that we've topped already. I do think we should have one more high coming to complete this wave 5. Just looking at where we came from in April, the share was at $29.55 at the low, and we're still more than 3 times higher compared to the April lows. So it's been a pretty mesmerizing climb in the past quarter, and I think a pullback here is pretty healthy to digest some of this move and getting fast money to take profit. Looking at gold, so we previously marked this path already for the bullish path. It was confirmed this week after this breakout that we're indeed now towards the wave 3 of wave 5. We have a target of 335 for 1.382 extension of this wave 1, based at the wave 2 low. So this is our minimum expectation for this wave 3. But the ultimate wave 5 target stretch all the way to 350. Looking at Apple, what has been happening with Apple? is, of course, we had the White House announcement that Apple would invest an additional $100 billion in the US on top of this $500 billion. And we had a reversal of this sell-off back above the 50-day moving average, back above the 200-day moving average, decisively bullish now towards our wave 3 target here. And I do think, a lot of it is money rotating from the likes of Microsoft Meta, which had performed exceptionally well in Q2, and now moving into the laggards of the Max 7 stocks and the large caps. So you finally see Apple breaking out of this range and potentially having golden cross pretty soon. And I do think we should get 260 in this next move. Amazon, in the near term, broke out of this bullish triangle. So now I think it will make a new high pretty soon. It confirms to me that we are moving towards this wave 5 high, which can be above 250. And if you just look at the volume profile here, there is a lot of accumulation interest going on. So we could probably even get past 250 in this overall rally. Google, we covered this at the beginning of this market update, broke out of this channel, very bullish move. That puts my read on the overall structure as a nested wave 3. So I think we're in wave 3 of 3. I would not be surprised we see a retrace back towards 200 in the coming week and this month, just to digest this very large move. I think RSI is now at 83, so that's a pretty rare event. And if you look at the last time it's this high, we'll have to go back to 2018. And in 2018, we had a sell-off after we reached this level of overbought. And then again, the time before that, 2017, we had a small sell-off, but it moved higher before a larger sell-off. So I'll just be a little bit more cautious about chasing it here, or I do think this is a pretty favorable spot to take some profit. Of course, it can move to the 200% extension of this wave 1 into 424, but that is in a stretch territory, and the risk reward is just not that appetizing. Meta reached the minimal expectation of the target region this week, so at 723, and it's managed to bounce back and climb above the 50-day moving average. I do think that this short-term downtrend is not yet done, and we have a still quite good chance of a deeper retrace back into this 680 to 720 range. There is a lot of support here in terms of volume profile, a lot of people buying in this region. So it may not dip below 680. Similarly, for Microsoft, it did reach our minimum expectation of 500 in this pullback for wave 4. And it has been trending slightly sideways in the past week. I still think we can get a slightly deeper pullback into the 670 here. So back between this 2 quarters, we have big money doing a big block trade, buying every single day, controlling the market upwards. But now looking at the price pattern here, we are getting the reversal and potentially lack of interest of buying it here. If you look at the RSI, the momentum definitely is now on a downwards trajectory. So I think the near-term pressure is still towards a deeper retrace to further digest some of this rally here. NVDA, very similar to Microsoft in terms of price action, we had a very smooth line up, and then Since mid-August, we're seeing a sideways move, and upon the last set of earnings, investors sold the news, and now we're seeing the stock below 50-day moving average. I do think we could reach 158 for the minimum target. The volume profile is very thin in this region, if you look at here. So there is a little bit of a vacuum. If we move down below here, make a new low, we could travel down here pretty quickly into the 150s. In terms of the fundamentals, so I covered NVIDIA's earnings this week. I do think they are still miles ahead in this AI journey, and NVIDIA is still going to make a lot of money from the infrastructure spend by the large tech companies around the world and also the government agencies, etc. But NVIDIA will eventually face more competition, both from other chip providers, but also the in-house teams of the large tech companies who are making their own chips that may not be as good as Blackwell, but on a price performance basis are much more beneficial to their own applications. Tesla is getting a bad rap for its false breakouts, just holding around the 20-day moving average. Every time it looks like it broke a triangle, it only comes back down. So it's really infuriating for investors, and especially frustrating because other stocks have gone up. So people do get a lot of FOMO when they hold onto Tesla and miss out the rallies from other names. But the overall structure is still a very bullish one. We're seeing higher highs and higher lows moving up steadily. The overall market is positioned upwards for Tesla, but it's just taking its time, consolidating and creating this base before the next move. If we look at where we are today, we're pretty close to the highs of June and May before Elon broke up with Trump. And at this time, investor sentiment was very strong, actually. We're actually back to those levels, and with a pretty strong supporting trend line here that hasn't been broken yet. And the thing about Tesla is when it rips, it does move rapidly higher. So, for example, 22% October last year, after the election, from 240 all the way to 340 in the space of a week. The cost of the business is in the waiting game and being frustrated, being stressed, waiting for the breakout. But when the breakout happens, most people wouldn't have caught it because they got shaken out beforehand, and they're trying to chase when it happens. So you have to choose for yourself whether this is the game that suits you, or you want something much more steady, lower volatility, lower surprises from its founder, etc. And my read is that we're in wave 4. I don't have a question about that. I do think we could reach for wave 5 again. The question on my mind is whether this wave 4 was sufficiently completed in August. This large drop here, intraday drop, did stand right above our 0.382 retrace of wave 3, which is a typical target for this wave 4. So there's sufficiency in this move itself, but the price action since has not confirmed that we're in wave 5 already. So now I'm just going to have to watch whether we have a breakout to the upside to confirm that wave 5 has started. Until then, I do think investors should risk manage in case it stretches deeper towards 130 for a sharper pullback. And that is very possible here because this wave 2 was pretty shallow. So the alternating theory is that if you get a very shallow wave 2, wave 4 can be steep because a lot of people might suspect the top is in already, and they're trying to cash out. Finally, SOXX Semiconductors ETF, it moves in line with NVIDIA pretty much. So it's below 50-day moving average. I think we're getting a retrace down to 229 potentially for the first target. And it's going to follow what NVIDIA is going to do. But there is a lot of volume support here in the 214 to 228 region. I think it's unlikely for stocks to break below 214, especially we have this 200-day moving average here as well. So that's it for today. Thank you for joining. See you next week.